Well, hello and welcome to this Money Control live stream, kicking off a brand new week, but it's on the back foot, so to say, given the fact that we've seen 6 straight week of losses for the index. In fact, coming off a losing week once again, 3-month low, that's where the Nifty is at, and not looking all that great. Caution is the word on the Wall Street. We've seen the India VIX also jumping past that 12 mark, and that's also signaling caution when it comes to the bulls. So let's see whether this week we can break out of this losing streak, because 5 years ago in 2020 we saw the Nifty, or the market rather, clock in a 7 straight week of losses. We are just about catching up to that. This is a holiday shortened week, given the fact that we have Independence Day holiday on Friday, but let's hope that we manage to snap out of that losing streak. But the GIFT Nifty will give you a sense that we are looking at a positive start, whether or not if we start on a positive note, whether or not we manage to sustain, that's something that we'll be watching out for. Tail end numbers that have come out have disappointed thus far. You have Tata Motors that came out with numbers. It was a disappointment, but outlook from the management for the second half was fairly okay. So let's see how the stock reacts to that. You have Siemens that came out with numbers. Margins were disappointment. So yes, the tail enders aren't looking all that great, but we have the brokerage verdict on SBI as well, which saw an inline set of numbers. So we'll take stock of that as well, and there'll be a large block deal as well to watch out for in the form of Home First Finance. So lots of stocks in focus. All your stock related queries will also be taken up, so don't forget to send in your queries to our live feed. We'll try and take them up as well. But before we move any further, quickly take a look at the top headlines at this hour. A stellar rally in tech shares on Friday sent Nasdaq to a fresh record high. The S&P 500 ended just shy of its all-time high levels. Shares of Apple ended the week higher by 13%. Asian markets trade mixed as investors await announcement on the August 12 deadline for US-China tariff truce and whether or not it would be extended or not. The GIFT Nifty is indicating a flat start with a positive bias for the Indian market. And crude oil prices remain steady as markets await the all-important meeting between US President Donald Trump and Russia's Putin later this week. Now, gold prices continue to remain volatile, trading near the $3,450 per ounce mark. The cabinet clears 30,000 crore rupees as cash compensation to oil marketing companies for LPG under recoveries. The payment will be made in 12 tranches until FY27. The government has also reduced the number of subsidized LPG cylinders under the PM Ujjwala Yojana. And Tata Motors reports a mixed set of numbers in the first quarter, with its revenue, profit and margins falling year on year. Volumes declined across the board and tariffs impacted 4% of Jaguar Land Rover's total sales. Management sees gradual recovery in JLR in the second quarter and expects passenger vehicle margins to improve 300 to 400 basis points in the near term. All right, taking stock of how the market fared last week. As I mentioned, 6 straight week of losses. Longest losing streak in 5 years. Over 25 Nifty stocks ended with losses. Sensex, Nifty, Nifty Bank, all of them shaved off nearly 1% apiece. The mid-cap index was down almost 1.5% for the week. And some of the key names that were among the top laggards were the likes of Adani Enterprises, Nestle, Apollo Hospital, Infosys, Jio Financial, etc. On the other hand, you had Hero MotoCorp, Titan, Tata Steel, Tech Mahindra. These were some of the top gainers on the index. In terms of Friday's performance, we did end below that 24,400 mark. Remember, 24,100. I think that's a simple moving average on the index. That is one level that traders will watch out for on the downside, and also the fact whether or not the Nifty can actually defend that 200-day DMA mark also or not. That's something that we'll be watching out for. All the sectors ended in the red on Friday. Bharti Airtel and HDFC Bank were among the top contributors to Nifty's losses. The mid-cap index also was down somewhere around 2%, with some stocks like PG Electroplast, for example, shaving off 20% after steep FY26 guidance cut. Also in focus will be Coforge. That stock was down 6% after its key client Sabre cut FY25, in fact, calendar year 25 guidance, but the company has said that it will not see material impact on its financials due to this. Aside of that, if you look at some of the futures and options cues, the Nifty put call ratio that fell sharply to 0.66 vis-a-vis 1.06 in the previous session. The India VIX also kind of rose by 3% to 12 mark, and of course it is trading above short-term moving averages. So yes, that's also signaling caution. But I want to talk about the fund flows, given the fact that FIIs have actually pulled out nearly 18,000 crore rupees in August so far. But on Friday, they logged their first equity inflow for the month of August. They bought somewhere around 1900 crore rupee worth of equities in the cash market. DI buying support continues. 7,700 crore rupees worth of stocks bought in the cash market by domestic investors. Talk about stocks in F&O ban. RBL Bank has entered the list, and PNB Housing Finance continues to be in the futures and options ban for today. But quickly bring on board Rajesh Palviya, Senior VP, Research Head and Technical and Derivatives at Axis Securities. Joining in, Rajesh, lovely having you here on the show. Good morning to you. Actually, not really good news in terms of where the markets have been heading. 6 weeks of losses and crucial levels on the downside in focus. But what's your sense? 24,344, that was the recent swing low. This week, would you expect that to be violated? In fact, 24,300 to be violated, or would you say that there are enough shorts in the system and we could be staring at a short covering up move in the coming days?
Good morning, Nandita. It's great to connect with you again. Looking at the setup, it's a sixth consecutive week where we are, making lower high-low formation. It clearly shows that, there is a sustained supply pressure in the market. Though sentiments are also on the weaker side as a lot of news flow coming from the geopolitical as well as the Trump tariff is again, giving everybody on a cautious stance. So looking at the near-term, short-term structure, now we are trading below to 100-day moving average for Nifty, and Bank Nifty is almost trading near to 100-day moving average support area. PCR is again almost in the oversold trajectory. So most of the large cap as well as the mid cap stocks are almost trading in their oversold trajectory for near-term perspective. Though uncertainty is still there, so investor and traders are not taking big bets in this market as everybody is waiting for this uncertainty to get over. Maybe some couple of days we could see some more volatility to remain in the system as still there is no clarity towards the tariff, what kind of tariff would be there going forward, and any kind of reversal can change the sentiment also. But till this reversal not happen on the tariff front, or what kind of reciprocal action or trade deals are going to pan out in the near term as well as in the short term, will give some sort of certain environment for equity market. But till the time, I think volatility would be there. On the downside, 24,200 is the next support area. If we sustain below to 24,450, immediate resistance is placed at 24,450 as the major put call writers are taking their bets at 24,400 to 24,500 range. So I think 24,450 is the first level. If at all we crosses those levels, some short covering action could be there as we are already in oversold trajectory. On the downside, 24,200 is the key support area. For Bank Nifty, the immediate level where we are trading, like 55,000 is the crucial level, and we are almost closed around those level. Any breakdown below 55,000 can open further more selling pressure towards 54,800, 54,600 zone. But looking at the near-term, short-term structure, we are almost at 100-day moving average. There is a possibility some pullback action we could see in the Bank Nifty, but on the higher side, 55,400 is the key resistance zone. So until the Bank Nifty not crosses 55,400, maybe volatile session would be there in the Bank Nifty also.
Okay, that's about the Nifty Bank Index. In the pre-open, I can see the Nifty Bank below that 55,000 mark, which you mentioned as a crucial point for the index. But just want to put into perspective, we have the crucial Putin and Trump meeting in Alaska on Friday. Our markets are shut, and as you alluded to the fact that there's been a lot of volatility, and with all the latest developments on the tariff front. But if there is a peace deal brokered, or peace deal that Trump and Putin arrive at, then perhaps we could see a knockoff of that additional 25%, that Trump had, has slapped on India because of its oil trade with Russia, right? So perhaps we would be looking at, a knockoff of that portion. So, we will of course be watching out for that meeting on Friday, and of course we'll be reacting to that on Monday because we have a holiday on Friday. But of course, you mentioned the Nifty Bank Index, Rajesh. SBI is one stock that will be in focus. Just about 2 minutes to go for the markets to open, by the way. The performance for SBI was broadly in line. Net interest income grew less than 1% quarter on quarter. There was a sharp jump in the other income, 55% on a year-on-year basis, which managed to lift its overall earnings as well. And if you look at the verdict, UBS is neutral, target price is at 880 rupees. And other brokerages have also given outperform rating, like CLSA for that matter, with the target price at 1050 rupees. The stock now is around that 800 mark. What would be the next crucial level to watch out for in SBI, and are you spotting a trade on this particular counter?
So, Nandita, if you analyze the SBI structure, despite of volatility in market, even we have seen a significant correction in the market, but SBI is still holding the ground. And since last 3-4 months, it's trading in the range only. 780 is the important support area on the downside, and the 830 is the resistance zone for the stock for this last 3-4 month consolidation range. Looking at the near-term, short-term structure, I think stock is still trying to hold the support area, and buying interest still there at lower level. So I believe that once stock manages to cross above 815, I think some short covering action we could see in this counter, and then possible up move towards 835, 840 we could see in the near term to short term. So at this juncture, I would advise hold your position with stop loss of 790. If it's break 790, then exit. Otherwise, hold the position. I think some pullback action towards 830 we may see in this counter.
Okay, that's the view on SBI. Hold that thought, Rajesh. We'll come back and talk about more stocks, but we are getting the first ticks, and it is with a negative bias that we've seen the market opening on a Monday morning, 4-5 point down on the Nifty. Sensex down somewhere around 48 odd points. Very flat start. Really trying to understand which way to go. Really, mid cap index down 0.2%. Down just about 100 points or thereabouts. The Nifty Bank index is also in the red as we speak. Advanced decline ratio right now is in favor of gainers. Early days to really comment on which way the trend will really pan out, but yes, it has reversed. 1:1.2. That's the advanced decline ratio. 926 stocks advancing to 1125 stocks declining at the current juncture. The Nifty is just about trying to get back into the positive zone, and just about managing to do so. 24,379 is where we are at. So yes, it is a tug of war between the bulls and bears. Let's see who wins by the end of the day. But let's take a look at the texture of the market in terms of sectors then. Which are the sectors that are taking a lead at the current juncture? Banks, as I mentioned, started the day on a negative note. Autos mildly higher. The FMCG pack is trading with the negative bias. IT also with the negative bias. Metals are holding out. 0.3% kind of gain on the metal pack. Pharma is another one that's holding out. PSU Bank, I think this index is taking the lead, 0.5% up on the PSU Bank index. The Realty pack is also trading in the green. So yes, it's a mixed start. Oil and gas pack is up 0.4%. Want to see what OMCs are doing, given the fact that Cabinet has approved 30,000 crore rupees in cash compensation for LPG under recoveries. So yes, all those stocks, HP, BP, IOC will also be in focus. Let's take stock of the individual movers then. SBI among the top gainers, given the fact that brokerages have given positive views on the stock post numbers. Grasim is taking the lead, 3% higher on that stock. Adani Enterprises, that was a big laggard last week, reversing course, 1% up. Tata Motors, by the way, up 1%. Numbers have not been great, but the management outlook has been good. They expect a gradual recovery in the second half when it comes to JLR. They've also maintained their FY26 guidance. I think that's something that has found favor with the street. NTPC, Trent, Shriram Finance, Wipro, these are some of the other gainers. On the other hand, you have ICICI Bank. This is the top laggard, given the fact that it has increased the minimum balance amount that needs to be kept in the bank. That is expected to bode well for margins. But ICICI Bank in the red right now, a top Nifty laggard. Asian Paints, Bharti Airtel, Reliance Industries, HUL, Adani Ports, Apollo Hospital. These are some of the other stocks that are not doing all that well. But I want to see what some of these OMCs are doing. IOC is up 1.5%. You have BPCL, that stock is up 1.5%, and HPCL as well, up 2%. So yes, OMC pack is upbeat given the fact that the cabinet has approved 30,000 crore rupees in LPG under recoveries. Coming to you, Rajesh, it's a fairly quiet open. We'll have to see which way really, we head. Right now, we are struggling for direction. And let's face it, there are no positive triggers as of now. As we speak, Nifty has reclaimed 24,400. But given the texture of the market, what would you be looking at or recommending to our viewers in terms of stock picks?
I think again on the Bank Nifty, some recovery is visible as we are trading near to the crucial level of 55,000, which is coincide with the 100-day moving average. So I think stock like SBI, ICICI Bank, as well as Bajaj Finance, these three stocks can be looked at from the banking and financial pack. The way these three stocks are shaping up, I think some more recovery we could see during the day for this counter. So here one can focus at this juncture. Another sector where we are focusing is on the automobile side, and I think TVS Motor is looking attractive. The way stock is almost trading near to its all-time high trajectory. Here also we could see some upward momentum. We are projecting target towards 3050 for TVS Motor. So buy and accumulate would be the strategy on the downside. 2940 should be your stop loss to buy. Again, on the SBI, as we spoke earlier also, it's now almost hovering at 815. I think any sustained move above 815 could trigger some short covering action in this counter. 835, 840 would be the next target. So here also one can hold on, or fresh buying can be deployed with stop loss of 805 for SBI also.
Okay, those are the recommendations coming in from Rajesh. Rajesh, I want to talk about Tata Motors. Since you spoke about TVS Motor, let's stay with the auto pack. It has given up all of its opening gains. In fact, it's trading in the red as we speak. The stock has been under pressure. Numbers weren't all that enthusing, but outlook, was a little positive given the fact that they are expecting some bit of gradual recovery in Jaguar Land Rover in the second half of the year. But tariff hit has is visible in the numbers, and the stock has of course gotten beaten down as well in the last I think 2 months or so. It has shaved off over 14%, and if you look at all the other charts like monthly charts, YTD charts, the stock has been under fair bit of pressure. Would you see more pain on the charts as well? It's at 635. Any chances of 600 as well being violated?
I think series of low top, low bottom formation in this counter, and the way stock is continuously moving in the downward trend only. There is no as such substantial recovery which we have witnessed in this counter. So overall structure is still on the weaker side. 700 is the crucial level on the high side, which is very far from the current level. Looking at the near-term structure, almost stock is struggling to hold its support area of 630, 640. That's the crucial level for this down move. Any breakdown below 630 can take further more supply pressure in this counter, and then we may see yes lower level towards 610 to 600 kind of zone for Tata Motors. So I think at this juncture, wait for some substantial recovery in this counter. Those who wants to buy, wait for some reversal pattern or some breakout of near-term resistance, then only one should initiate the long position. Maybe we could see further more lower level towards 605 or 600 level if it's remain below to 645, 650 zone.
Okay, that's the view on Tata Motors. But one stock that has been grabbing the headlines and for all the wrong reasons is PG Electroplast, and we have quite a few queries as well on this particular counter. Shaved off over 20% on Friday, another 10% cut today. What does one really do? Is this a time to look at taking a fresh position? Debu K wants to know that, and we have Anunay as well. I think he is holding it at 763 or thereabouts, making quite a bit of a loss. Wants to know whether he should book losses and exit or average. What would you do with this stock? Because would you call it catching a falling knife? Should one just exit, or how does one really navigate this stock now?
So we have a very stellar rally in this counter, but since last 4-5 month, stock was consolidating in range only, and there is a breakdown post earning announcement. Now almost stock is down 35% for August itself. Looking at the breakdown on monthly as well as on the weekly chart, we believe further more pain is likely to be there in the stock prices as there is unwinding trade is taking place in this counter. So maybe we could see further lower level towards 500, even 480 kind of zone in the continuation of this down move. There is no as such sign of a recovery, or there is no buying interest despite stock is already corrected so much in a very short span of time. So I think one should wait. Those who wants to buy, one should wait. But if you bought it for near term to short term trading perspective, I think stop losses are already triggered as there is a clear breakdown on the near term chart, and possible down move towards 480 would be there. Though long term structure is still intact, but maybe we could see down move towards 480. Maybe some more consolidation would be there at lower band, and then it may take time to recover as it's a serious crack on the monthly chart. So it would take time to recover. So if you have patience and you can hold it for a little longer period, then hold it. Otherwise, for if you have bought for trading perspective, you may exit and try to buy some other stock. Maybe at lower level, you could get again, opportunity to buy this stock. Let's the stock to settle down this supply pressure.
Okay, let the supply pressure settle down. But if you have patience and have a longer term perspective, then perhaps you can look at it. Another stock, that's feeling the chill, so to say, in trade today is Voltas. Numbers came out, it was a miss on all counts. Net profit slid somewhere around 60%. Revenues were down 20%. Margins also almost halved at 4.5% vis-a-vis 8.6% on a year-on-year basis. If you look at the stock, unenthusing. It's just about less than 100 rupees away from the 52-week lows of 1135. Do you think it's looking oversold, or do you think it could go below that 52-week low as well? How are you looking at the charts of Voltas?
So the stock is now trading near to its multiple support area, which is placed at around 1200 zone. So any breakdown below 1200 would open further more downside towards 1160, 1140 zone also. Still trend is on the weaker side. There is a breakdown on the near term chart after this gap down. So I think looking at the near term, short term structure, I would advise avoid at this juncture. Let the stock to show some recovery, as the stock is still trading below 250-day, 20-day moving average, which is a sign of weakness on the near term structure. So until the stock not crosses above 1300 zone, trend is likely to exhibit on the bearish side. Maybe we could see lower trajectory below 1200. 1150 would be the next target.
1150, the next target on a Voltas. But let's talk about a Siemens as well. The stock is down somewhere around 3% or thereabouts. Margin pressure was clearly visible in the numbers. Profits also were down 3%, a slight miss on what was expected. Revenue up 15.5%, that managed to beat expectations, but margins came in lower at 12% vis-a-vis almost 13% in the same quarter last year. The stock did well on a 6-month basis, but I think it saw some kind of a reversal. Would you expect the stock to head lower, or would you see say that it could snap out of this losing streak pretty soon? Because on a 6-month basis, the stock has given good 9% kind of returns.
So on the near-term structure, there is a correction is happening, and structure is on the weaker side. The stock is almost trading now near to its immediate critical support area of 29.20. Any breakdown below 29.20 can open furthermore supply pressure towards uh, 2800 kind of zone. That's the next major support area if it's break below 29.20. So I think wait for stock to settle down after this correction. Maybe we could see some support buying around 2800. That's the next major support area. However, on the higher side, the supply zone, which is placed on the near-term chart, is at 3050, 3060 zone. So until the stock not crosses those level, we may see, bearishness is likely to be there in the counter, and we could see further lower level. So 3050, 60 level needs to watch. Any move above that can trigger some short covering action in this counter. So if you want to switch in the same sector, I think Cummins is looking more attractive in terms of technical. Yes, there is a breakout on the near-term chart. So Cummins India is looking promising. And if it continues to trade above 37.50, we could see a rally towards 3900, even 3950 kind of zone.
Okay, that's about Siemens. But let's talk about some other stocks in news as well. Anything that you like from this news of LPG? Compensation has come as a shot in the arm, and of course, crude prices also now back around that $66 per barrel mark. Last 1 month, we've seen, all these OMCs have a wild ride, but if you look at the last week performance, it's been fairly good. So out of the 3 names, which one would catch your fancy now?
So I think HPCL has recovered from its 100-day moving average, and the kind of support stock has taken, and there is a sign of reversal on the near-term chart. If it continues to hold above 405, I think some more upward momentum towards 435, 440 we could see. So HPCL is looking attractive with stop loss of 405. Again, if you analyze on the BPCL, the same kind of structure, but if I have to compare from HPCL and BPCL, I would go with the HPCL, because here we are expecting that structure is a little stronger compared to the BPCL, and maybe we could see further higher traction towards 430 zone, 435 zone. So HPCL would be our choice from OMC pack.
HPCL, that's the choice from the OMC basket. But before we come to more queries, I want to talk about Home First Finance as well. We saw a large trade in the counter at around 9 a.m. 10% equity exchanged hands worth 1300 crore rupees in the block deal window, and the shares changed hands at 1190 rupees, 1190.5 rupees per share. At a discount to Friday's close price. But looking at the stock, solid run in the last 6 months. Last 1 month, the stock shed 13%, but today it's up somewhere around 3% or thereabouts. Do you think we could see a resumption of the up move that the stock has been seeing? But because in the last 1 month, we did see the stock take a pause.
Yeah, so there is a consolidation activities going on the monthly chart, and stock is holding the earlier breakout level of 1190. So I think those who have already bought the stock or wants to buy at current level also should keep a stop loss of 1190 as a strict stop loss, because any breakdown below 1190 can trigger some profit taking in this counter, and then we could see further lower level. But till stock is holding above 1190, there is a possibility that we may see some upward momentum. On the higher side, 1290 is the first resistance for any pullback. Any breakout above 1290 can take stock higher towards 1350, but follow the stop loss of 1190 if you are buying at current level for Home First.
Okay, 1190 stop loss on Home First Finance. But let's take stock of all the queries that are trickling in this morning. Just want to start off with a query on TCS from Manish. He wants to know what's the view on TCS from a long-term perspective. Of course, given the fact that there are a lot of uncertainties, given the fact that it will have an impact, tariff would have an impact on client spends, and that would impact business for most of these IT giants. And of course, there's uncertainty on the AI front as well. Within the large cap names, post numbers, how is TCS looking, and how would you look at Infosys now?
So still uncertainty is there towards the IT sector, and most of the stocks are exhibiting the supply pressure. Again, in the TCS as well as in the Infosys, there is a sustained supply pressure since last 5 6 week. Both stocks have broken their near term, short term moving averages. The kind of supply which we are witnessing in most of the IT stocks is clearly showing that there is no confidence at street at this juncture for IT pack, as still uncertainty is there towards the AI and how this AI is going to shape up and what kind of business impact they are going to have in the coming quarters. So I think there is a pressure in the most of the large cap IT stocks. TCS is almost trading near to its crucial support area, which is placed at around 22950. So if it continues to trade below 3100, maybe there is a high possibility that TCS may break below 2950, and then if it's happen, we may see further lower level towards 2850 also. So I think at this juncture, avoid IT stocks until unless there is no sign of reversal on the near term chart. So for TCS, 3100 is the reversal point, and for Infosys, for 1480 is the reversal point on the higher side. Till these levels are not taken out on the higher side, I think trend is likely to exhibit on the weaker side, and we may see further lower level in the both the counter, like in the TCS as well as in the Infosys.
Okay, and what about Coforge? That was also one big laggard on Friday. One of its clients had cut guidance, but the company did maintain that it will not have a material impact on their finances as well. Today as well, the stock is trading with a negative bias. Any thoughts on the mid-cap IT space, including Coforge?
So I think again, mid-cap IT is also under pressure, as we are seeing that large cap ITs are continuously in the down move, and we have seen the similar kind of behavior in most of the mid-cap IT stocks also. But still, if we analyze on the longer term time frame, Coforge is still better compared to other IT stocks, as on the long term chart, stock is holding its supports. So those who are looking for a little longer period can buy and accumulate in staggered manner in this corrective move. Maybe we could see a further lower level from the current level, but if your strategy is to buy on a staggered manner with a small quantity, would give some good return, because as trajectory is still on the bullish side for the long term perspective. On the downside, I think 1550, 1520 would be the next major support area. So I think buy in staggered manner towards in this correction. 1460 should be your stop loss if you are buying for longer term perspective. On the higher side, 1680 is the hurdle for the stock. If stock crosses those level, then some reversal or some resumption of up move we may see in this Coforge. But again, if we analyze other mid-cap IT
Sure.
stocks, like Birla Soft also broken its support area. So I think buy only in a staggered manner. Don't buy in a one go, because still we may see further more downsides.
Okay, that's about the mid-cap IT pack then. One last query I want to get addressed before I introduce my next guest. Pooja Khanna wants to know your thoughts on K Fintech. She holds shares at 1120 and she wants to know whether it's a good idea to add more and average down, or and of course she also wants to know the support and target levels for the next 6 months. We also have Viraya who wants to know your thoughts on K Fintech. What should they do really with this stock?
So next major support area for the stock is placed at around 1020 and 980. These two levels are important for this correction. If your horizon is 6 months, yes, you can average out in this decline. On the higher side, 1200 is the first hurdle. On the higher side, if it crosses, then I think you may get further higher level towards 1400 also. But in the decline, 1029.80 would be the level where you can average out for 6 month horizon.
Okay, that's the view on KFinTech. Hope that answers your query. But with that, I would like to thank you, Rajesh, for taking out time and joining in and helping us, understand the texture of the market, and of course, also addressing all our view queries. Look forward to interacting again sometime soon.
Thank you.
Thanks a lot. On that note, just quickly take a look at the market. We have edged back into the positive zone. Marginally so, but the bulls have the upper hand at the current juncture. Let's see how things really pan out. And the advanced decline ratios also tilted in favor of gainers as we speak. But to understand where the markets are headed from here, what should the investment playbook be going forward, and what should one really look out for in the rest of the year? Let's get you a big market voice then. Joining me is A Balasubramanian, MD and CEO, Aditya Birla Sun Life AMC. Mr. Bala, lovely having you here, joining us this morning. There's been the most dreaded word, tariff, that we have been navigating since April, and last week 50%, that was the most talked about figure. Where does this really leave us, both in terms of economy and the market? Of course, we will be training our eyes on the crucial meeting between Putin and Trump that takes place in Alaska on Friday. How would you really look at this entire tariff situation and what it really means for the economy and market at large?
Broadly, this it's been an uncertain time. I think it's a new uncertainty that has now come from a different kind of risk on tariff. But having said that, I think the last 3 months, when I look at the way it started in January, and then subsequent to that, how it has taken a shape in different form with the different countries with the different tariff rates. I think it looks like both the side, they want to negotiate very tough, and especially US want to negotiate tough, given the fact that whatever they are doing is to actually to bridge the fiscal gap that they have built over a period of time. So therefore, the need come from fiscal management in the US. At the same time, it cannot actually lead to a significant increase in inflation overseas as well, which is what I think Powell is waiting. The Fed governor is waiting for rate cut to be done. He also feels that it can lead to an increase in inflation if the tariff goes up significantly. Therefore, they have to do the right balancing. So I would assume what has been happening the last 2 weeks, especially for India, I think it's about it's all about negotiation tactics. And given the fact that India and US has always been a great partner for many number of years, I would only assume that you set the bar high so that you have enough room for you to negotiate, and therefore you settle at lower number of numbers, which is what my own belief would happen. I think globally, if this week political leaders meeting would lead to some bit of semblance coming, especially with the geopolitical risk, I think it can even lead to some bit of peace, which could be derived from the political side, which ultimately would also bring in some kind of solace as to the tariff talk concerns. But right now, I think it's too early to take a call whether it is going to be bad. I think nothing is going to get implemented till such time they get onto the negotiation table and agree on some numbers, which is be mutually acceptable, which is what India has been doing quite effectively. Even US president also has been doing the same. I think he's been setting bar high and then finally settled down at lower numbers. So that's what I would assume. Nobody wants to work against the interest of the economic power, which I think every country is now enjoying. Therefore, it'll have to just wait and watch. But definitely, the uncertain time is not something which we can say that everything is sounding pretty good. And given the fact that these uncertainties will not know the answer.
Sure. Bala, just tell me one thing. Of course, we are expecting the figure to settle at a much lower level, but are the markets prepared for anything above 15-20%?
So I think now I would assume most of the things are getting priced in, given the fact that this has now become an open talk. And people anyway, one good thing in our market is always look for alternate. The moment something comes that for which some new thing has come and generally get discounted, given the fact that historically that the market functions. But having said that, Anything which, of course, it comes in the final number, we might see some bit of correction in the market. But again, that will be very, very marginal given the fact that one, this is a season of result season, and India has been progressing well as far as pushing the growth towards 6.5% plus. Reserve Bank of India has been cutting interest rates, and they may have been ensuring interest rates remain somewhat at affordable number, and the private capex is beginning to also show some kind of uptake. Therefore, the impact of tariff to some extent would have only in few sectors, but otherwise, broadly from the economic point of view or market point of view, I would assume is only getting discounted.
Okay. Okay, fair point. You alluded to the RBI's rate cutting cycle, right? But given the RBI's language last week, would you expect the RBI to go in for a prolonged pause now, or would you say that post a Fed rate cut, we could see another rate cut coming in? Because the RBI governor has kept growth forecast unchanged, although inflation gives us room for more rate cuts. How are you looking at this? Do you see then an end to the rate cut cycle here in India right now?
Hey, what is most important now is RBI has done its jobs by way of cutting rates, by way of providing liquidity, and also making it easy for banks to operate and NBFC to operate by way of removing some of the restriction which was imposed on companies, banks before by way of regulatory intervention. And that's something my own belief is would probably see would probably take a pass for the time being. But having said that, I would also assume the pressure on RBI, not a pressure on RBI, for the banking system point of view, the pressure will remain for them to pass on the interest rate cut to the larger beneficiary of the borrowers. And that we might see it happening, that RBI will wait for the transmission of rates to happen at the ground level. And by the time, I think there will be a lot of clarity which will come in terms of the action which the Fed will take on the interest rate front. My belief is once the tariff thing is over, I think US will start looking at inflation number. As it is, US numbers on growth is showing a slowdown. If there is a rate cut in US, say about 100 basis points the next 6 months to 9 months, then RBI will have some room for them to cut rate. At this point of time, while RBI may have room to cut rate, from the system point of view, the rate expectation of coming down is not there. I think what is most important from RBI point of view is the transmission of interest rate to the larger beneficiary of the borrowers, so that the growth of 6.5% gets further upgraded to a higher number by way of lending growth coming back.
Okay. Bala, what would be the biggest risk for the market right now? Of course, we know how the tariff situation is panning out, but we've also seen FIIs turning net sellers again, right? In July, they pulled out money. In the month of August so far, they've already pulled out 18,000 crore worth, stocks as well. So, going forward, do you expect FII sell-off to be that one big risk? And, in the absence of any positive triggers, what should one really watch out for? What is that one factor that could provide some bit of a leg up to these markets?
For the market, the risk I would probably say is a prolonged dull period. That could be one of the risks, wherein the returns may not come, and the hype that generally gets created in the market, that may probably take a backseat. At the same time, the expectation of growth coming back, led by low interest rate regime in India and government push on infrastructure, that will continue. But from a FI's point of view, I think relative valuations will play a role. I think right now the entire world is looking at, in terms of emerging market flows, is more towards China, given the fact that they are now pushing a lot of things from the growth point of view. If the geopolitical risk gets reduced, there is also high probability some bit of money will go to other emerging market as well. So from the FI's flows point of view, probably I would assume the allocation towards India will start coming in as we start seeing improvement on the numbers, on financial numbers, rather research numbers, the next 2-3 quarters. And then we'll also see the rate cut happens in the US. As US rates comes down, the interest rate differentials will get narrowed further. We will probably see the flows coming back from overseas investors in terms of emerging market allocations. At this point of time, I don't think any emerging market allocations towards India will grow up significantly, given the valuation of India is at reasonable level. But as the lending starts picking up and growth starts coming back, we'll see that flows coming in. From a risk point of view, I will probably think that a prolonged period of sideways market could be one of the things that could lead to some bit of marginal flows coming down. But otherwise, the risk is, I think, remains the more of living with uncertainty with some element of hope to things settle down the next say few quarters.
Sure. We talk about how FIs have been pulling out money, but on the other hand, we've had domestic investors who've kept their faith, right, in the Indian markets. In fact, last week, Monday, we saw DI buying worth over 12,000 crore rupees, I think on the 7th of August. So that's one bright spot, right? And today, of course, we have the Amphi data also coming out, where some market experts believe that we could see record equity inflows as well. Although on a weekly and daily basis we see DI buying, but the momentum, if you compare it with the start, this also be a risk that domestic investors, start pulling out money or something like that, and could that also be a risk?
I think pulling out risk will always be there, but I think the way the mutual fund investing has now become the way of investing in the financial market, I would probably assume mutual fund flows will remain solid. It may not actually keep going up. Currently, the inflow that comes anywhere between 30 to 40 crores per month inflows, that may stay around the same level, and incremental rate of growth could probably go sideways for some time. So that's the only risk which will be there. Otherwise, the regular flows, which will, I think, has come leading to net inflows in the mutual fund industry, I think that will continue. I don't think that will be an issue. And from market point of view, the lack of participation by individuals' participations and also supply of papers. I think we will now suddenly see a lot of supply of papers coming in, and large issues are coming and able to raise funds. To the extent the supply of papers coming in the market right now is coming in the form of IPO, offer for sale, and also the promoters selling and so on and so forth. As long as the supply pipeline remains very, very strong, they will also have some bit of it can work as a hanging sword from the rising market point of view. To the extent we'll see, despite the flows coming in, despite domestic institutional investors buying, we must also keep this in mind that all the buying that is happening goes into the filling the applications in the NFOs, IPOs, as well as on the offer for sales that's coming in. It's not directly going chasing the stocks list part of the Nifty or other index companies.
So, Bala, what does one do with their SIPs? So, this is one question I get asked by a lot of people. They want to know whether they should, look at reducing their SIPs, topping it up. How should one really look at deploying money when it comes to SIPs in these uncertain times?
The SIP, we must remember, is a silent saving. It is not something it's going to give you excitement on a month-on-month basis. Nor will help. Nor will tell you that how much is the value that reflects on the basis of your monthly investment. I think the real value of the investment will be reflecting in your portfolio only over a period of say 3 and 5 years period. So the SIP is not something we are saving it for quick gain. It's being meant for building a portfolio for the long-term goal planning. Therefore, I always keep saying that SIP is a silent way of saying, and subsequent important plan is SIP. And also every goal that individuals have got, those individual goals can be fulfilled only by investing for long term at a regular interval. I think one of the biggest boon that the industry has got is the SIP way of investing has become the way of investing. Therefore, anybody still has got a question mark in their mind whether he should stop the SIP or reduce the SIP ticket size and so on and so forth. Unless until they don't have money, unless until they are not able to see their own earnings coming in the next say few years very clearly, then only those people I think should have those kind of decision to be taken. But otherwise, the SIP should continue. On the contrary, I keep saying that if you don't have SIP, you start investing in SIP. If you have already an SIP, increase the SIP ticket size. And if you have an SIP for say 1 or 2 years, keep it for the perpetuity. And that's the way I think it should be built. I think the very fact of the market that $10 trillion economy is not something it's not going to happen. It's going to happen for a period of say next say 4 or 5 years. That is being the case. Staying invested in the market and continue investing in the market to the SIP will be key to success. And given the fact that we must also remember, given the fact interest rate today is very low, savings account deposit gives you about 2.5 to 3%, and going up to say 6% depending upon which bank you will deal with. At the same time, deposit rates for 1 year or 3 year, 5 years have come down very sharply. At the same time, bond market rates, if you take 10-year bond yields, is close to about 6.35. And only the asset class that can give you a better return than this kind of asset class. That too, if you invest for say more than 5 year period, which is an equity as asset class. So therefore, investing in SIP, I think will remain key.
Okay, got your point. Investing in SIP would be key, of course, going forward. But let's talk about the recently not concluded. We are just at the tail end of it. Looking at the earnings season, of course, it has lacked excitement, and the expectations were also fairly muted. Any pockets that you feel are undervalued post looking at the numbers?
Difficult to say. I think undervalued, again, it depends upon value investing principles. I think today, if we go by, if we take IT as a sector itself, valuations got corrected. Uncertainty, of course, remains with respect to how the global landscape is changing in IT space. Balance sheets are clean, have huge cash flow that they have, high dividend yielding kind of companies. So I think valuation need to be today looked at not on the basis of P multiples alone, is also how the balance sheets are constructed. And basis if we say, I think there are many companies in the space. But I think from a cheap valuations point of view, I think it's all about how do you want to take that. Though I not looked at it more in deep in terms of sector wise, the valuations numbers at this point of time. Therefore, I'm not able to immediately comment on this. Rather, if you look at the broader level, the balance sheet constructs for most of the companies is pretty good, and the leverage ratios are low. The earnings are very, very steady. But as things settle down, as interest rates comes down, once they start spending from a private sector's point of view, even global investments into IT development will also increase quite significantly. Therefore, we have to look for those triggers before we jump the gun into certain sectors, based on the valuation.
Okay, a couple of more questions then, Bala. In terms of funds, would you advise investors to look at multi-asset fund or multi-cap funds? What's the best way to navigate this phase of volatility?
First and foremost, given the uncertainty that we are talking about on equity market in terms of where the market will trend, and spotting the market trend is also equally important, going up and down in terms of equity exposure. Therefore, we keep suggesting that balanced advantage fund is the one which take care of that the question mark that one has got in mind. It has good allocation between equity and fixed income, and also keep moving our equity asset allocation depending upon the market view. Therefore, first allocation should go to balanced advantage fund. Second is, of course, multi-asset allocation fund, which invests in across categories: equity, fixed income, gold, silver, REIT, and InvIT. 5 asset class in which invest. And therefore, the customer's point of view, there is a strategic exposure of 60% equity, and the rest of the 30% exposure dynamically moves between these 3-4 asset classes. And that's another asset class which is the current market point of view, and now taking into account the question that comes in everybody's mind is another asset class. And third, of course, is the multi-cap fund. Often the question comes in terms of between large cap and mid cap and small cap, how one does that. In fact, one can play this through the flexi cap fund, not necessarily has to be only multi cap fund. Between flexi cap fund and multi cap fund, both the asset class can be chosen. Because here, whatever the question that one has got in their mind, whether to invest in equity, whether it will remain bullish or bearish, and whether invest in gold and other asset classes, should I invest in large cap and mid cap, this question often remains as a common question in the investor's mind. So keeping this in mind, first priority should be flexi cap fund, then second is balance advantage fund, and the multi-cap fund.
Aditya Birla, I think recently also launched, factor-based indexed funds, momentum as well as, I think, quality. So, my question is, why are fund managers really betting on momentum and quality to outperform going forward?
I think today's world is about quant-based investing. I think the model-based, quant-based, analytical-based. The market provides the trend. Sometimes as a money manager, if an active manager if I invest only on the bottom-up stock picking approach into stock picking, both on stock picking as well as sector allocations, there's another factor which is coming. Factor-based investing is purely driven by model and formula. Therefore, the intervention of money managers looking at the fundamentals are less, but looking at broadly on the basis of the what the model says. So going by that, momentum is one, takes care of the Nifty 500 50 stock, Nifty 50 500 momentum among the 500 stocks from the Nifty 500. That's something we have chosen. I think BSC 500 we have chosen if I'm not wrong. In that 50 stocks will be the momentum stocks will take, which is the best momentum stocks, so that you'll be able to capture the trend that available in the market through the factor-based investing. Second is the quality 50 stocks among the 500 companies, which I can take into account the point that you raised earlier, valuations, where you see the big money can be made, and purely on the basis of the past trend, and also how the companies are fundamentally positioned. So these two we are doing it for the simple reason that our job is to provide bouquet of product, a variety of product for the investors to choose from the bouquet, and within that, the customers get an opportunity actually to participate purely on the basis of the theme that seems to be prevailing as of today. At least quality is something which will have a long-lasting nature. Momentum will have in a rising market, you will see more momentum. In today's market, the momentums are the least. But however, having a product in that category would help us in a time of big volatility period. The momentum portfolio also will start reflecting on the underlying portfolio constructions purely on the basis of the trend that exists in the market, both on stocks as well as sectors.
Sure. Okay, that was all about momentum investing and quality investing. But any closing comments, Bala? Any advice to traders and investors as to how they should be navigating this phase of volatility, and of course your expectations for the rest of the year?
I think it's a time of consolidation. I think after seeing a big growth as a country for the last for almost 10 years, we are now going through a period of consolidation. Definitely, all the steps that is being taken by the government of India is more towards making the market to become larger, bigger, the economy become bigger, make it more self-sufficient, and have less dependency on the global market. And then that's the way I think the business is being built, the economy is being built. Therefore, staying convinced on this, the trend, I think, very important. It's very easy to lose sight in the current noise that we are seeing in the global market space. I think sometimes they ought to ignore the noise, as we do not know this. Any of them people are discussing about things can actually reverse the decisions as quickly as they announce the decision. Therefore, it is not worth speculating. It's not worth taking a bet which way it will go. I think staying invested for long term, I think, would be key. Therefore, stay invested in the mutual fund, continue to make investment in mutual fund. That's what I would say. From the market point of view, I would probably say this year we'll see market forming a new high. I think once that settles down, clearly I think there are steps that is being taken by the government to boost the consumption, good monsoon, supporting the agriculture growth. Agriculture output has been very good. Rural income has been rising. I think it's just a question of time for the spending to pick up, which will start reflecting on the overall growth momentum. Therefore, having that hope and optimism, I think, would remain key, given the fact that we have gone through almost 1.5 years of consolidation period, which is almost necessary so that we don't become a complacent in our own economy. And during tough time, India is known for taking tough stands or tough decisions to get the growth back on track. Therefore, we must live with that hope and stay invested for long term.
Okay, that's a word of advice. But I'm just pushing my luck. And one more last question, then, Bala. Any pockets or sectors in the market which you believe should be looked at, from an investment perspective over the next 3 to 5 years?
Clearly, I think the core sectors are there. I think banking and financial sectors will remain one of the core sectors. And given the fact that huge investment is happening in across different sectors of the country, capital goods sectors will remain one of the medium to long term sectors to look at. Defense is another sector. A lot of companies in this space, very limited companies are there, and the huge investment coming in this space, in the defense space, and that's something will remain as a sector to watch out for. And I would also say, think that IT companies, they have already gone through a period of uncertainty. Results are anyway reflecting. They are going through an uncertain period. The best time to buy these sectors when there are a lot of uncertainty surrounding the sectors. That is the time you get the better valuations. That's something it's worth keeping a close watch on.
All right, that's the view on all the sectors that look promising at the current juncture. Of course, IT as well, given the fact that there is a lot of uncertainty surrounding this sector, and the best time to buy is when there is a lot of uncertainty. With that, Mr. Bala, thank you for joining in this morning and sharing your thoughts. Always a pleasure, and I look forward to more interactions going forward as well.
Thank you. Thank you.
Thanks a lot. Well, that was Big Market Voice, A Balasubramanian, sharing his thoughts on the markets, on the pockets to look out for, on the flows picture, and of course, the expectations from the market for the rest of the year. But with that, of course, we've come to the end of this edition of Opening Bell. We are in the green as of now, just about 0.2% higher on the index, 47 odd points up, but it's a good thing that we are above that 24,400 mark. The Sensex is well above that 80,000 level as we speak. The mid-cap index, although marginally higher, but it's still, showing green ticks on the screen, and the Bank Nifty as well, showing some bit of strength, almost 0.4% higher, and the advanced decline ratio, however, is tilted in front of, in favor of laggards, I beg your pardon. And if you look at the gainers, you have Grasim, Tata Motors now in top gear, up 2.5%. SBI also among top gainers. Adani Enterprises trend, Dr. Reddy's, these are some of the stocks that are dominating the gainers list, and the losers list is smaller than the gainers list. So that's another thing to take heart from. Titan, by the way, is the top laggard as we speak, but completely timed out. Thanks a lot for tuning in. Of course, I'll see you at 3:30 p.m. with closing bell. Don't forget to tune in for that, and have a great trading day. Stay tuned to Money Control for all your other news and updates, and I'll see you soon. Thank you.